Welcome back to Investing Talk Podcast.
Today we're looking at SoundHound AI. This is a really fascinating play in the world of artificial intelligence.
It really is.
It brings together these truly explosive fundamental growth numbers alongside some very real, very significant near-term headwinds.
And we need to dissect which force is stronger for you, the investor. Is it that accelerating demand for their product or, the current market noise surrounding their operations?
Exactly.
As usual, before we start, subscribe, like, and comment to this video to support the show. And if there's a specific company you want us to look into, leave it in the comments below.
So let's get into the analysis. For a company like this, we absolutely have to start with the fundamentals.
You have to.
Because the revenue story here is the core thesis. It's why this company attracts so much attention and, frankly, why it carries such a high valuation.
Okay, let's unpack this growth because the figures are genuinely eye-popping.
They are.
When we look at the results from Q2 2025, revenue came in at, $42.7 million? That wasn't just good. That was a massive 217% increase year over year.
An incredible number.
That kind of figure signals more than just organic growth. It shows a genuine acceleration in client demand. And it's driven primarily across their key sectors, right? Automotive and enterprise.
And that acceleration in demand is the crucial point. It tells you the market is really validating their proprietary tech.
Yeah.
What's critical is that this momentum didn't just, vanish in the next quarter. When they reported Q3 2025, revenue hit $42 million.
So pretty much held steady from Q2.
Exactly. And while the percentage increase cooled slightly from that massive Q2 surge, it still represented 68% year-over-year growth, which importantly beat consensus expectations by about 3.75%.
So they are maintaining strength, which is great. But in the world of high-growth AI, sometimes revenue means nothing if you're just hemorrhaging cash.
A very fair point.
What did we learn about efficiency this quarter?
That's where the Q3 report provided a significant relief signal for the street. Their earnings per share was only a loss of 3 cents.
Okay, only 3 cents.
And that was significantly better than the forecasted loss of 9 cents.
Wow.
This smaller loss is key. It indicates they are managing costs more effectively than expected as they scale. It suggests that, cost discipline is taking root, which is what separates a good growth story from a sustainable one.
And here's where it gets really encouraging for the margin watchers out there.
Mm-hmm.
We're seeing operational efficiency improve dramatically. Their non-GAAP gross margins have been steadily climbing, hitting 59% in Q3. You just don't achieve that kind of operational leap by accident.
You're absolutely right. That improvement is directly linked to 2 things. First, they're finding significant synergies from recent acquisitions.
Right, they're optimizing.
And second, they're moving more of their own cloud solutions in-house, which reduces reliance on, expensive third-party providers. This margin improvement suggests the business model is becoming inherently healthier the larger it gets. And management clearly believes this trajectory is sustainable.
How do we know that?
Because they raised their full year 2025 revenue guidance to the high range of $165 million to $180 million. That's a strong vote of confidence.
That focus on hitting the high end of their guidance is a strong indicator. But let's pause and talk financial stability versus that long, difficult path to profitability.
Okay.
They have a strong balance sheet right now, $230 million in cash and cash equivalents, and crucially, they carry no debt.
Which is huge.
It sounds like a long runway, but when you're executing 68% growth, you're spending heavily.
Precisely. That cash position provides the necessary fortitude. However, free cash flow is still negative, and heavily so.
Why is that?
They are pouring money into R&D and sales investments to secure those big automotive and enterprise contracts. So the runway is strong, but they are burning through it.
Got it.
The timeline management has set is the critical factor here. They are actively targeting near break-even profitability by 2026. For you as a learner, that's the milestone you need to watch.
Okay, so that sets up the first major question. If they are growing so fast, that 217% revenue surge, how much of that is proprietary?
Yeah, the defensibility question.
Exactly, because fast growth is great, but it's meaningless if any competitor, say a Google or an Amazon, can just copy it. So let's pivot and discuss what protects that growth, the moat.
The moat rests squarely on their proprietary voice AI technology. They've moved beyond simple command recognition into what they call their agentic AI.
And that's the key piece of differentiation.
It is. Their core IP isn't just listening. It's understanding context, intent, and then following through on complex multi-step actions.
And how do we quantify that superiority? because every AI company claims they have better IP.
We look at the metrics they provide, which illustrate a performance gap that's hard for incumbents to close. For instance, they boast 10x containment rate improvements.
Okay, break that down for us. What's a containment rate?
So the containment rate is essentially how often the AI successfully handles a user's request without having to hand it off to a human agent, or just failing. A 10x improvement means enormous cost savings for their clients, especially in call centers. It means more tasks are just done by the AI.
That translates directly into the client's bottom line.
Exactly. And beyond that efficiency, they report 25% higher NPS. That's the Net Promoter Score.
How likely customers are to recommend it.
Right. And a 15% better overall customer satisfaction. Plus, their system can be deployed with 35% less effort than rivals. This level of superiority translates directly into high switching costs.
Yeah, once a massive automaker integrates the system deeply, they aren't going to just pull it out because a competitor offers a 5% discount.
Not a chance.
So that performance gap provides the foundation. Let's talk about how that translates into market share, especially in those high-value, sticky markets. Where's this technology showing up?
The key proof point here is the strategic partnership they secured with OpenTable.
That was a big one.
It's huge. This isn't just about search. This integration enables true transactional in-vehicle voice AI reservations.
So no pulling over, fumbling with your phone, or trying to navigate a clunky reservation app on a center console?
None of that. You're driving, you realize you need dinner reservations, and you simply talk to your car and book a table immediately.
A major improvement to the user experience.
And this is far more than a gimmick. This partnership covers reservations across more than 60,000 restaurants.
Wow.
That instantly accelerates their foothold in high-value, high-frequency voice transactions inside the car. This move essentially turns the vehicle into a mobile commerce platform.
And creates a very real barrier to entry for other AI players who are still stuck on simpler commands like, play this song.
Precisely.
That synergy certainly ties the technology directly into monetization and scale.
Yeah.
So we have explosive growth and a validated proprietary moat. But as we established in the intro, the market sentiment around the stock hasn't been universally positive. In fact, the narrative seems to be driven by entirely external factors right now.
That's the major tension point for any potential investor. If we look at the immediate market mood, it is predominantly bearish.
How bearish are we talking?
It's reflecting an average sentiment score that hovers around negative 0.40, and the major driver behind this negative outlook is the overhang from multiple class action lawsuits.
And this is where the legal noise creates that uncertainty. What exactly are these lawsuits alleging?
The core allegations revolve around financial reporting and internal control weaknesses. Specifically, they allege issues stemming from recent large acquisitions.
That's why in Q3 and Amelia, right?
Those are the ones. The allegation is that the company may have overstated the goodwill associated with those purchases.
So that uncertainty creates persistent legal noise, forcing the market to question the reliability of past financial statements, even as the current revenue numbers look fantastic.
It's the classic struggle. Outstanding future potential versus historical accounting uncertainty.
And these legal challenges aren't ending soon, are they?
They are not. The deadlines for these cases are running through May 2025, which means this legal cloud will continue to be a persistent source of noise and possible risk for the better part of the next year.
Okay, so you have this strong fundamental story clashing violently with that legal risk. Let's contrast that negative sentiment with what the technical analysis is telling us. It often seems like the price action is disconnecting from the bad news.
It is absolutely showing resilience. The technical viewpoint offers a strong bullish structure. Analysts who chart the stock are noting that it's establishing higher lows.
That's a good sign.
A very good sign. And after the Q3 revenue beats, it appears to be forming a potential classic cup and handle pattern.
For those who aren't chartists, what does that mean?
It's a technical pattern that shows a period of consolidation followed by a potential breakout. It suggests that long-term strength is quietly building underneath the current volatility.
That's fascinating. A long-term structural setup, ignoring the near-term drama. What about momentum indicators?
We're seeing a potential major momentum shift there, too. The 50-day moving average is trending above the 200-day.
The Golden Cross.
Signaling a potential Golden Cross setup. This is a very powerful technical signal for momentum traders. It basically means the shorter-term trend is confirming and accelerating the longer-term trend.
Okay, so we have lawsuits pushing sentiment down, but technical indicators suggesting accumulation and structural strength. This brings us to the human element analysts and company insiders. Are they aligned?
No, and this is where the conflict really sharpens. On the one hand, you have major institutional firms like Mizuho and Cantor Fitzgerald raising their price targets to $15.
They're clearly bullish. They're saying ignore the noise, buy the technology.
Precisely. But on the other hand, we've seen increased insider selling recently, which naturally contributes to that overall negative sentiment score we mentioned.
Which always looks bad, even if there are good reasons for it.
Right. It could be for any number of reasons, tax management, personal liquidity, but it still sends a cautious signal to the market. However, if you look at the broader institutional accumulation, those 13F filings show that big money is generally adding to positions across the AI peer group.
So where do we go from here? We have this tense standoff. What are the near-term events that could serve as the catalyst to either break the stock higher or confirm the bearish view?
We have a very clear calendar ahead, which is helpful. The immediate focus is the anticipated Q4 2025 earnings release expected in early February 2026.
And what's the consensus there?
Consensus revenue targets for that quarter are sitting robustly between $45 and $50 million. Hitting that target will push them right toward the top end of their raised annual guidance.
Which would be a huge relief signal.
A huge one. And then looking slightly further out, there's potential for major product reveals at CES 2026.
Right, this is where we might see more about that agentic AI you mentioned.
Exactly. This is where they'll showcase AI that can not only understand a request, but autonomously plan and execute a series of steps to achieve a complex goal. That kind of capability is what differentiates them from the basic voice assistants we use today.
That is a true step up in utility. And finally, what about that crucial path to financial stability?
We anticipate an investor day post-earnings where management will detail the specific roadmap to achieve that critical 2026 break-even path. That will provide essential transparency on the cost side.
Beyond those fixed dates, what's the speculative upside here, the kind of chatter that drives these stocks?
Well, there is speculative chatter, though it's unconfirmed, about expanded automaker integrations following the success with OpenTable.
Oh, okay.
If they manage to onboard major new automakers, or if they significantly expand the scope with existing partners, well, that could accelerate their 2026 hypergrowth beyond even what analysts currently expect.
And we can't forget the macro environment.
Absolutely. The macro tailwinds are strong. The AI sector rotation remains favorable. Enterprise adoption is only accelerating, and any potential interest rate cuts would generally favor high-growth companies like this.
Okay, let's bring this whole complex picture together by circling back to the biggest risks. You mentioned the persistent gap losses. Quantify that risk for us.
The top risk is, without question, the combination of the ongoing class actions and the deep gap losses. When you look at their net margins, they are still deeply negative, around minus 211%.
That number sounds terrible on its face. What does a 211% negative margin actually mean for an investor?
It means that for every dollar of revenue they bring in, they are currently spending about $2.11 to generate it.
Wow.
This is why that cash position isn't just a nice to have, it's an absolute necessity. They're aggressively buying market share right now, but it is not cheap.
But the company isn't just sitting on its hands, right? They are actively mitigating that risk.
They are. The mitigation strategy is robust because of that financial foundation we discussed. The $230 million in cash and no debt.
That gives them breathing room.
It gives them the fortitude to manage the legal uncertainty through May 2025. You couple that with the rising revenue guidance and the operational fixes they're implementing to improve gross margins. They appear well-positioned to manage the turbulence.
So it's a race against time, but they have a powerful engine.
The ultimate investment question for you is whether the fundamental growth engine, those 217% revenue surges, and that agentic AI moat can outrun the legal and accounting noise. The real question isn't just whether they can hit break-even in 2026, but whether the market will value them as a traditional SaaS company based on margins or as a fundamental AI infrastructure play based solely on market share and proprietary tech.
That's our look at SoundHound AI. Make sure you subscribe to the podcast so you don't miss our next analysis.